Hello everyone, my name is Phil Blancato and I'm from LTAM Asset Management. Welcome to another quarter-end wrap-up call about what went on in the market the last few weeks and more importantly, where we think things are going from here. Well, hopefully where you are, it's warmed up a little bit. Here in New York City, we are finally starting to see some buds on the trees. It's been a long, cold winter. I don't think we're above freezing for all but just a handful of days from December all the way into March. And believe it or not, that type of situation has a pretty profound impact on our economy and the markets. Perhaps you've noticed that the first quarter of the year was pretty volatile. We've become pretty accustomed with the market going just about straight up for the last, 6 years. This is now the fourth longest bull market in history and is the fourth strongest bull market in history. Not the first, but the fourth. We still think there's some room to run, but this quarter was pretty volatile. And the reasons for the volatility were things like a very unusual set of macroeconomic data. The economy didn't function really that well in the first quarter. We saw the Federal Reserve start to talk a lot about raising interest rates and some concerns around that. We saw oil prices go from $100 a barrel all the way down to $50. And the big concern, that earnings season this time around was going to be much less than anticipated. Instead of a 5% expansion of corporate earnings, a 3% reduction. All those weighed heavily on the market. And yet, when you look at the returns for the first 3 months of the year, January was a negative month, actually almost 3%. But then turn around, February was a near positive month, almost 6% up for the month. And then March was down just slightly. Actually, on whole, I know it may not have felt that way, but the S&P was actually up about 95 basis points for the first quarter of the year. I bet it didn't feel that way. There were lots of 150 plus days and 200 minus days. Heck, there was a day in March where we had the best unemployment number we've had anywhere since the recovery, and the market was down 1.5%. So yes, the market has been volatile, more than we've been accustomed to. When the Federal Reserve stopped quantitative easing, stopped printing money, it brought some volatility to the marketplace. The market had to stand on its own merit. And in the first quarter, we've seen some bumps, but we actually don't think that's a permanent thing. When we look at stock market volatility, there was a couple other factors we think played in which are really important. One, yes, the data was mixed in the first quarter. The unemployment numbers weren't as good as they've been. We saw new jobs data, but just not as quickly. Manufacturing still growing, just not at the same rate. Consumers saving more than they normally do, over-saving. And we saw broad-based economic factors, whether it's manufacturing or the broad health of the economy and spending, not be as robust as we've seen. But we think that's a lot about, one, this was one of the coldest winters we've had in a very long time. In fact, there are over 300,000 people between Boston and New York City that didn't go to work on one or more days during this winter. Well, that has an impact on production. 10 plus feet of snow in the Boston area has an impact on production. Couple that with, in the West Coast, there was a very significant slowdown on some of the major West Coast ports. So the story goes that if you flew in on a plane into the LA airport, you would see the line of ships going out into the ocean simply waiting to offload their goods and services. So that has an impact as well. So yes, the data wasn't great. There was some concerns about weather in the West Coast, but by and large, I don't know that it was bad as it made out to be. We think this noise about earnings is far overdone. We don't think earnings are going to be as bad as they projected to be. The other big thing that's been talked about is the dollar. That as the U.S. economy has strengthened, the dollar has really soared to real significant highs over everybody else, and that has caused our U.S. corporations to earn less. And they're right. And in fact, 40% of our largest company get earnings from overseas, and those companies are going to earn a little less because the dollar has strengthened. But that doesn't affect mid-cap stocks and small-cap stocks. In fact, it probably helps them because now they can buy goods and services cheaper, and they can still export because of the uniqueness of our products. So in the end, we don't think that the strong dollar is going to be nearly as detrimental as it's been made out to be. So that's when we look at the equity market by and large, it was positive for the first 3 months of the year. We think it's going to continue to be strong the rest of the year. We think it's actually going to really get healthy here as we get out of this malaise of the West Coast, which is over with, and the cold weather season and the strengthening dollar. Energy companies are going to struggle, but outside of energy, we actually think things are going to be pretty good, especially in that small cap and that mid cap sector. When we look overseas and we think about Europe in general, Europe has been in an unusual situation. We know they've got record levels of debt, high levels of unemployment, but an interesting thing happened in Europe in the last couple of years. The stock market's been really struggling. In fact, we've had our least amount of international allocation than we've ever had here at the LTAM Asset Management Group. But recently, we've seen a return to Europe. One, they started on a quantitative easing program. They're printing $60 billion a month. Two, the austerity that they went through has really helped. Many of the countries, such as Greece, believe it or not, have now a balanced budget. And 3, their stocks are cheap. So based on the fact that there's some cheap stocks out there, we think there's a bit of a recovery going on in Europe. And you're seeing it in the portfolios that our allocation to Europe is really adding value. And in fact, we've even expanded it over time because there's some value to be added there over the near short term. Fixed income is a whole other ballgame. When the Federal Reserve talks about raising interest rates and that the U.S. economy is strengthening enough, they could perhaps raise the federal funds rate from 0, maybe up to 0.25 or 0.50 or even 0.75. That gets a lot of people concerned. It makes the equity market get very volatile. And by the way, anytime the Federal Reserve raises rates, eventually the equity market outperforms it and does better. So don't worry about it when it comes to stocks. Short-term volatility, but for long-term success. But in the bond market, it can mean a lot of pain, because a slight rise in interest rates can have a real negative impact on fixed income. However, we're not as bullish on fixed income rates going higher, interest rates going higher, as so many people are. You see, we're still at a very low rate of inflation in the United States. And even globally, inflation is very, very low. So we don't think interest rates are going to go much higher. Couple that with the fact that bonds overseas are yielding less than American bonds, yet our bonds are much more safe. So for example, the U.S. Treasury today yields around 2%. And a bond, a 10-year U.S. Treasury from Spain is yielding around 1.4. So which one would you rather own, a Spanish bond or an American bond? And in fact, in some cases, they're issuing bonds at negative yields, whereas American bonds still have positive yield. Those external forces cause our bond market to remain suppressed. And for that, I don't think interest rates are going significantly higher anytime soon. Maybe methodically, slowly going up over time, but not anything significant. So on total, when you think about the first quarter, yeah, it was volatile. Yes, in fixed income. Yes, in equities. But both ended up positive for the quarter. But in the end, you know what really matters? Diversification. For the first time in a while, there was a threat that the S&P may not be positive in the first quarter, yet our portfolios were all up. So you're seeing the S&P not be the primary leader, and that's where diversification matters. We're getting success out of small caps, mid caps, international stocks, even emerging market. So diversification is working. In fact, if you look at the performance of all the accounts, they're doing excellent this year, and it's because of the diversified nature of the portfolio, which means less risk, but at times when the S&P is not the number one market, we should outperform like we are right now. So in summary, don't be concerned about the volatility. We think it's relatively temporary. It's not going to be a straight line this year. The Fed is going to keep talking about interest rates, and there's going to be moments where the market will ebb and flow because the government's not as supportive as it once was. But we still think equities end up around 8 to 10%. We think oil is going to end up in that $60 a barrel range. So for all you, the consumer out there, you'll still get cheap gas. We think by and large international is going to recover a little bit, and we can get some real value out of the portfolio, and interest rates should stay relatively low. So again, thank you for listening today. We hope it was helpful for you. We appreciate the trust and confidence you've placed in us. Please contact your financial advisor at any time if you have any questions. And hopefully it's warming up where you are, because it's finally starting to warm up here. Take care. Have a great spring, and we'll see you in the summer.